Art Collins here. Going to revisit something that I introduced to you about a year ago, the 5-minute equity bond spread. To recap, you set it up by creating a 5-minute S&P chart, day session only, 8:30 a.m. to 3:15 p.m. Central. But you put an insert in there, 30-year T-bond chart using the same S&P day session hours, 8:30 to 3:15. Now, if you're not on a platform, it's easy to just eyeball the signals, so don't sweat that part. Between 8:45 a.m. and 12 noon Central Time, by the S&Ps, if the last two 5-minute bars close higher than they opened in both the S&Ps and the bonds, okay? You don't see them both conforming together like that all that often. But when they both go up, you want to be a buyer of the S&P. Conversely, when you have two 5-minute bars in a row where they both close lower than they open twice in a row, then you go short. Use a $400 money management stop. Flip to the opposite position as new signals emerge. And exit anything that you're still in at the 3:15 p.m. day session close. So from the beginning of 2015 through March 2nd, 2021, you had $50,000 net profit on 1,404 trades. 40% were correct. $35.73 average, 73-cent average trade. $12,437 worst drawdown. That into your eventual net profit gave you a 403% increase in your account had you started with a $12,000 worst drawdown amount. Looking good across the board, especially good in the Russell. $52,000 with an 88.90 worst drawdown for a 587% return on account. Now, again, as this is a revisit, I think it's logical that we do a yearly breakdown to see how it's been doing lately. Again, this would be pretty much virgin data, 2020 and 2021. Not much help in 2020. And we're back on track for the first couple months of 2021 in the S&P. Much better 2020 performance in the Dow. Again, consider this the same as virgin performance. These rules were assembled, I believe it was in March of 2020. A little off track this year. In the NASDAQ, pretty much even performance for 2020 and so far this year. Same for the Russell. Wouldn't have been happy trading the mid-cap, of course, but looks like it's regaining its footing somewhat if you want to risk that illiquid market. So anyhow, as I said last time I showed you this, S&P momentum tends to be fortified by same directional T-bond movement. The S&P and T-bond system works in all 5 major U.S. equity-related futures markets, providing robustness and a wider array of trade opportunities. You do have a reasonable stop loss in here, so this is more than just a theoretical bias. And it has continued to perform pretty much in the year since its inception. So file that under what have you done for me lately. Check this out. And you can reach me here. Until next time, folks.